Studios, the ausbiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB. I'm Danny Okuye.
And I'm Juliet Sully, and you're in green to match the markets today.
I am. I thought you might have worn red. We could have been little Christmas
elves.
elves.
A bit of red.
Exactly.
This is kind of my candy cane skirt.
We'll have to work on tomorrow's outfits
Yes.
because, quite frankly, we just keep on talking about these bull markets that just keep on going up. And today we have seen continued buying in the ASX 200, and it looks like it's closed up 56 points or 0.76%, and the CBO 200 was also up by about that order of magnitude.
Yeah,
Jules.
indeed. It was actually a 10-month high. We can see there the CBO up by about 0.7%, and really broad-based buying across the major sectors. But as you mentioned, getting very sky high towards these record highs. If we have a look at the three themes, and you were telling me or reminding me, because I did study this in Year 7, but that was a little while ago now, about the story of Icarus.
Exactly. So the story of Icarus, he was trying to escape from jail, and he had his fake wings and he was flying up into the sky, and his dad said, don't go too high because the wax will melt your wings, your
Don't
feathers.
get too close to the sun.
Sun, sorry, not the sky. And he died. So I guess the moral tale of that is no, you're not going to die. But the markets are, I think the ASX 200 is about 100 points off its record high. We really are seeing a melt up at the moment. And speaking to lots of the experts today, just making the point tactically, well, maybe just be a bit careful. So sky high, we have been flying.
Indeed, and also maybe the moral, listen to your father. Consumer caution as well. I mean, consumer stocks rallied really hard, but that update from KMD Brands, which is of course the New Zealand company, but listed here and owns Kathmandu, Rip Curl. Look, they saw a bump in Black Friday sales, but not enough to offset a 12.5% decline in sales for the first 4 months.
Absolutely. So just showing that the consumer is very fragile at the moment, and these Christmas sales will really, really be interesting. I don't know if you have, but I've been getting the January Boxing Day sales advertisements already into my inbox. So I don't think it's going to be a clear-cut situation that all retail is really, really strong. I think the consumer could be under pressure.
I was at Bondi Junction the other
junk
day.
heap.
Could not move, and especially in some of the, I guess, what you would say the lower cost like Kmart, the queue was insane.
Well, Kmart, that's interesting because Wesfarmers shares have been performing so well. So the consumer really trading down at the moment, I think, which again is indicative, which might be good for Lovisa.
Indeed. All right. Now, our friend Carl's coming up, and he loves to say primates for prime rates for China. They were on hold today.
The primates were on hold.
The primates were on hold. The monkeys are staying on hold, and that is mainly due to the fact that the PBOC didn't lift in December, so the banks aren't lifting their lending rates either. Having a look at our banks, though, some really good gains coming through today.
Absolutely, and it looks like Macquarie continuing to run very much risk on. Markets do well, Macquarie does well. Also, Westpac up by over 1%.
Having a look at the mining space, I mean, we're still watching a lot of moves coming through in these iron ore players. If we get to the mining stocks, there we go. Fortescue coming off records, BHP, Rio looking good, South 32 up 0.6%.
And I thought we'd have a look at the healthcare stocks because these three sectors are what moves the ASX 200. And as we can see, great to see for some long-standing shareholders, ResMed continuing to rally up over 1%, and CSL up to $284 per share. And let's have a look at the second page because Helios was one of the standouts today, up by over 3%, but pretty much green on screen almost across the board there.
Indeed. All right, well, getting to some of those top corporate stories, we're continuing to see this M&A mania. Orica snapping up Canadian sensors and data delivery company Terra Insights for about 560 million Aussie dollars. Its shares were down by about 3% today.
And it's just that acquisition is expected to be completed in the first half of next year, and it will be funded by existing cash and undrawn bank facilities. And electric conveyancing platform PEXA fell down 11% following an update on the acquisition of a UK business, Smoove.
Smoove. Well, Transurban has appointed former NAB Chief Financial Officer Gary Lennon to its board. The toll roads operator saying Lennon will start his position as a non-executive director from March 18. Its share price just slightly higher, and gold stocks doing really well today as well.
Yeah, and just we've already touched on it, KMD Brands, which owns the Kathmandu outdoor clothing brand. We can see shares off 6% after they said sales had fallen 12.5% below last year in its latest trading update.
And that was the stock of the day. We had Sean Cartwright of Anandara Asset Manager and Michael Wynn of Medallion Financials join Koshi on the call to share their buy, hold or sell verdict on KMD.
You know, some businesses that seem to be able to do well throughout the retail cycle and others which are a bit more cyclical. So you look at things like Nick Scali, JB Hi-Fi, they tend to be sort of the high quality retailers that most people think of, and they've been able to withstand most cycles. Kathmandu, or now KMD Brands, has always been quite up and down. And I mean, that chart alone sort of reflects that. You know, it's either too hot during winter or too cold during summer. There's always seems to be something as basic as that which can really throw the business. A little bit nervous about that broader retail space, particularly when it's a very specialised retailer such as this. So look, for mine, I'm not going to give it a buy. I'm probably going to give it a sell because we've never held it, and unlike
the fact that they're reporting that sales are down, whereas we're seeing things like JB reporting relatively well, shows that this truly is a discretionary type trade. Nothing to get excited about, and I'd probably sell. And if you were looking for something in the retail space, I'd be going for a Nick Scali or a JB Hi-Fi.
Mates Day. Let's get to Kyle Rodder from Capital.com for a wrap on the market today. Hi Kyle, where are you? Is he there? There he is. Oh, we can't hear him.
Oh!
Uh-oh.
Can't hear you.
What's happening out there,
Oh,
my
no.
friends? We'll just talk while
Kyle's just sorting himself out. Hear no evil, see no evil.
He's shocked
There you
that,
go. Are you back?
He's back. See no evil, speak no evil.
Can you hear me?
Yes, hello.
Yeah.
So the buy everything rally, Kyle, is it, you know, Santa's on his way?
I think
It would
Santa's
seem so.
arrived.
Yeah, every sector higher for the day. So it almost seems indiscriminate in a way that everything's basically going up. And of course, it's a function of interest rate cuts and lower risk-free rates. So it's a lot of momentum now. We haven't seen a huge move in bond markets over the last couple of days. A few basis points here and there. Nothing to sort of justify these 0.7, 0.8% rallies in the ASX, or effectively these kind of moves that we've seen on Wall Street. But nevertheless, clearly the story tells itself that the market is trading on that momentum of rate cuts next year, despite the gentle pushback of some Fed officials in the last few days. And like you said, that buy everything rally persists, and I mean the way things are going may persist for a few days yet, barring kind of sort of shock to disrupt things.
And the Nikkei also continuing its strong rally. So it's interesting because China just can't catch a trick, apart from the fact that the primates haven't moved. But the Chinese market is just looking loveless at the moment, whereas Japan, which was loveless for 30 years, just continues to make new highs. Kyle, what's going on?
Yeah, I don't know, maybe the shoe's on the other foot. Certainly the BOJ yesterday coming in a little bit dovish was supportive of Japanese equities, and we're basically at 33-year highs again, a little bit shy, but we'll call it close to 33-year highs again on the Nikkei. So fairly positive there. We've got the 10-year JGB yield down at about 55 basis points as well, which, considering there was some nervousness that maybe that would hit or push through 1% when obviously we had this big bond sell-off a few months ago, and may sort of catalyse a greater tweaking from the BOJ in terms of its yield curve control policy. Things have changed very quickly there, and the yen has been in a bit of an uptrend recently, but again, after yesterday's kind of dovish guidance from the BOJ, it's softened a little bit, and that's been beneficial for the Nikkei as well. But Again, contrasting that, China's equities are looking woeful. We priced the China, what we call the China A50, but even if you look at the CSI 300 as well, at levels that we haven't seen since basically the end of 2019, so 5-year lows, or the start of 2019, I believe, close to 5-year lows. So that's probably a very significant area of concern going into next year, because it's basically the only market in the world that hasn't participated in this everything rally, and we can sort of rattle off the reasons as to why there's such weakness there, ranging from obviously very sluggish fundamentals. Sentiment apparently is absolutely shot within the economy and both the investment community, and we've got these ongoing issues with the property market. I think the thing that's sort of a bit of a mystery is how deeply embedded are these problems, how deep do the weeds go. There's all this talk that perhaps even as bad as the property sector does look, and the financial stability risks that exist in China, as bad as they are, that they could be even worse than many are anticipating. It has to be said, a lot of surveys are suggesting that there's a building bullishness towards Chinese assets, just because historically they're so undervalued. But the flip side of that is maybe they're cheap for a particular reason, and maybe reflecting against some severe systemic risks within the economy, and maybe that sort of dreaded balance sheet recession, which was responsible effectively for the two or three lost decades that Japanese assets experienced. So a huge contrast in both markets. China just not participating in this everything rally at all.
All right, let's move to the UK and what we could see. Actually, Scotty and I were talking earlier about the fact that a whole generation basically hasn't seen inflation at these levels that we've been faced at these 40-year highs, but it could see some easing from the CPI read in the UK.
Yeah, coming down slowly, perhaps not as quickly as the rest of the world. And I think if you do look at the UK, maybe because of sort of post-Brexit labour markets, there has been more of a sort of a wage price dynamic or spiral even over there compared to, say, Europe, the US, or any other sort of comparable developed economies. So at the moment, last week we had wage growth numbers coming down to about 7.2% year over year. The inflation numbers tonight are expected to show a further moderation in headline inflation to sort of 4.5%, core inflation to sort of the mid to low 5%. And there's still expectations in the market that the Bank of England will be in the position to cut next year, despite the pushback that we got from Governor Bailey, who was very, very clear and kind of almost strident in a way of his commitment to bringing inflation down first and foremost, and not even really considering the kind of 2.5 rate cuts that are currently priced in the UK or from the BOE next year. So it should be fascinating. As far as the markets are concerned, I mean, if you do look at the pound itself, the cable, does seem to be sort of creeping higher in a little bit of an uptrend. That's more of a US dollar story quite naturally, as yield differentials compress as we see, sort of treasuries come down in response to expectations for rate cuts from the Fed next year. But again, the UK is an interesting case, probably more exposed to some of those supply shocks, both in terms of, energy markets as well as labour markets, and that's what's keeping inflation higher. But this data tonight is expected to show that the trend is in the right direction, but perhaps, maybe not falling as quickly as other global economies. And also, sort of indicative of a Bank of England that won't be in the position to cut rates quite as aggressively as perhaps, again, sort of their G4 counterparts or markets are expecting from their G4 counterparts.
Kyle, hasn't sentiment changed? I was just quickly trying to remember. It was the 1st of November when you had your lovely Sydney panel, and I remember, I'm going to put it out there, I was the lone goose saying that rates might come down next year and everyone was for higher for longer. It's pretty staggering, isn't it, the shift in the narrative, like how much has actually transpired in literally a few weeks.
Yeah, and I guess, because things can move so quickly, if you look at the next risk, it could be that, we might get a sort of bounce back once again. I'm a big believer that markets tend to oscillate and overshoot in both directions in as they sort of trend. Fundamentally, the big risk now, especially as we get these kind of really lazy holiday market conditions where momentum and CTA accounts or whatever start just basically driving prices higher for no really rational reason, is that we've got 6 cuts, we'll call it roughly 6 cuts in the market for the Fed priced in next year. We've got this sort of subtle pushback from Fed officials recently. All we would potentially need is some strong data to kind of unwind maybe 2 or 3 of those cuts being baked in, for asset prices then to have to kind of, obviously adjust again from, from a technical standpoint, what is historically, stretched and overbought levels, at least when you look at US indices. So by all means, I'm sort of sympathetic to the view that we will see cuts next year, and maybe, there won't be the soft landing as well that we're getting sort of discounted in markets too, which seems to be the prevailing narrative. But there is, I think, the fairly significant risk that the timing of this is a little bit wrong, that we've just got momentum sort of chasing markets a little bit too far to one direction. Everyone's on the one side of the boat, and then, maybe at some point in January we get a little rude shock at some point. But nevertheless, again, going into sort of these Christmas periods, you tend not to get those kind of things until the new year. So for now, we sort of just run with the high. But yeah, that would be the next sort of risk of volatility is some strong data that potentially unwind some of those cuts that are baked into the market.
Absolutely, Kyle. As always, thank you so much. Great to see you. And
Happy Primates Day.
Happy Primates Day. And if I don't speak to you, have a happy Merry Christmas.
Sounds good.
All right, see you, Kyle.
Okay, Kyle Aroda from capital.com. So let's now check in with some of the leaders and the laggards in today's trade and see, there we are. We can see very much the gold mining sector, the lithium sector running hard today. Sayona Mining up by over 12%.
And Chalice Mining, you were speaking about, was it the CEO saying they don't want to have
short
sellers?
Yeah, they just feel that it's a geopolitical risk when you're developing critical minerals in this country, and take a lead out of Korea, which actually bans short selling.
All right, to the losers on the day. PEXA we discussed, 11.3% lower. Neuron Pharmaceuticals was also around yesterday, down 4.5%. Orica we also discussed. And ARB and Bega also there too.
And let's check in with some of the small cap movers and see what's been happening in that space. And the small cap leaders today, maybe they've gone, yes, there we go. Fluence, haven't seen that one for a while, up by 22%. And the likes of Southern Cross Gold and gold stocks were in focus today, up by almost 11%.
And the losers at the small end of town today, Atlantic Lithium, we discussed sort of the moves in some of those lithium players, Byron Energy, Catalyst Metals down 6%. Looking ahead to tonight, what's on overnight, we mentioned with, of course, Kyle, the CPI print from the UK, but a little bit of data coming through out of the US as well.
Yes, US mortgage applications. There was very strong housing starts actually out in the US yesterday. US consumer confidence, current account balance, and we've also got BlackBerry, General Mills and Micron Technology reporting as well.
And looking ahead to what we can expect tomorrow, Thursday, derivatives expiry for the ASX, and of course ANZ holding its AGM, and then looking very, very, very far ahead. The third quarter US GDP will come through Thursday night, as well the Philadelphia Fed Activity Index for December. All right, so we are at that 10-month high on the ASX 200. Let's recap where the market is. Of course, as we were saying, sky high. Where's the ASX 200?
So it does look a little bit of profit taking. Came in just at the end. The CBO 200 up 0.7% or 10.4 points, and the ASX 200 up 48.8 points, 7,537 or 0.65%. But we do have, I was just having a quick look, the minis, the futures, looking like they're in positive territory over in the US.
Yeah.
And it would be very unusual to have 8 weeks of gains, but you never know, this melt up rally, slight gains at the moment in terms of the US futures, but hey ho, we'll have to wait and see.
I'm not going to tempt it by wearing red tomorrow though. I think we should at least try and keep
Maybe
this.
go a different colour. Yeah. Maybe yellow.
Yellow
see.
would be nice. Bright and sunshiny. We will see you tomorrow.
Exactly. Have a great evening.